Hey everyone, welcome back. You guys sent in some really interesting stuff for us to dig into this time, especially this interview with Larry Dyer on Global Money Talk.
Yeah, it is pretty fascinating stuff.
So we're going to take a deep dive into the U.S. economy and financial markets.
Try to make sense of it all.
Exactly. What does it all mean for you?
Right.
So,
I think the most interesting thing Dyer points out is this idea of a Truss moment for the U.S.
Oh yeah, I remember that.
Remember what happened in the U.K. last year? You know, when
the new prime minister's plan to slash taxes?
Yes, slash taxes in it.
Yeah, just totally backfired.
It backfired spectacularly.
Yeah, so is he saying that the U.S. is headed for a similar meltdown?
Well, not necessarily. He sees some parallels with the potential policies of the incoming U.S. administration.
Okay.
Things like extending the tax cuts and increasing spending,
Yeah.
which could really balloon the deficit and national debt.
Okay, but the U.S. isn't the U.K. We have a lot more economic firepower, don't we?
That's true.
Yeah.
The U.S. has more levers to pull when it comes to adjusting spending and revenue.
Right.
Plus, the U.S. dollar is still the world's reserve currency, which gives us a bit of a cushion.
Okay.
But the Liz Truss moment serves as a cautionary tale.
Yeah.
It shows how quickly markets can react when they lose confidence in a government's fiscal policies.
Yeah, and those bond vigilantes that Dyer talks about.
Right.
The investors who can make or break a government's borrowing plans.
Yes.
They're watching closely?
Absolutely. They're constantly assessing risk
Yeah.
and looking for any sign of instability. If they sense that the U.S. is headed down an unsustainable path,
Right.
they'll start selling off U.S. Treasury bonds,
Uh-huh.
which could drive up interest rates,
Yeah.
make it more expensive for the government to borrow money.
Okay, so what does all this mean for the average person?
Right.
How could these potential policy changes actually hit our wallets?
Well, one of the most direct impacts could be on interest rates.
Oh, yeah.
If rates rise, it could affect everything from mortgage rates to car loans to the cost of borrowing for businesses.
And that could trickle down to higher prices for consumers, right?
Exactly.
Yeah.
Inflation is already a concern, and rising interest rates could make it even harder to get it under control.
Right.
On the flip side, the incoming administration's policies could also have some positive effects,
Yeah.
such as boosting economic growth.
Right. So it's kind of a mixed bag.
It is.
So where does the Fed fit into all of this? I mean, they just cut interest rates, but
Right.
how are they navigating all this uncertainty, especially with a new administration coming in?
The Fed is in a tricky spot.
Yeah.
They're trying to balance the need to control inflation
Yeah.
with the need to support economic growth.
Right.
And as Dyer points out, they're data-driven.
Yeah.
They'll be watching the economic data very closely and adjusting their policies as needed.
And it's worth remembering that the Fed has shifted gears pretty dramatically in the past.
Oh, absolutely.
Like under Volcker and Greenspan,
Yeah,
they had to make some tough calls to tackle inflation.
absolutely. And they'll likely have to make some tough calls in the future as well.
Yeah.
The question is, will those calls be enough to prevent a Liz Truss moment in the U.S.?
All right, so we've got this potential fiscal policy drama playing out.
Yes.
We've got the Fed trying to walk a tightrope.
Yeah,
What does all this mean for the economy as a whole?
right.
Are we headed for a soft landing,
Right.
a recession,
Right.
or something else entirely?
That's the million-dollar question.
Yeah.
Dyer brings up some interesting historical examples to consider, like the S&L crisis of the late 80s and early 90s.
Oh, wow, yeah.
This was a major financial crisis,
Yeah.
where hundreds of savings and loan associations failed due to risky lending practices and deregulation.
So it sounds like there was some specific excesses that lead to that crisis, not just the Fed's actions.
Exactly.
Okay.
And then you have the dot-com bubble burst in the early 2000s.
Oh, right, yeah.
Investors poured billions into internet companies with little to no earnings, and when the bubble burst,
Yeah.
it sent shockwaves through the economy.
That was a classic case of irrational exuberance.
Yes.
And then, of course, we had the housing crisis in 2008,
Right.
which was fueled by subprime mortgages and lax lending standards.
Right. Each of these recessions had its own unique set of triggers.
Okay.
Dyer argues that we're not seeing those same glaring excesses in the current economy
Okay.
yet.
So no flashing red lights, but we still need to be cautious.
Yeah, I think so.
And I'm sure a lot of people are wondering what this all means for their investments.
Right.
So let's talk stocks, bonds, the whole shebang.
Yeah.
What are your thoughts on the investment implications of all this?
Well, when it comes to stocks, we have to acknowledge that valuations are pretty high right now.
Okay.
The Shiller PE ratio,
Uh-huh.
which measures stock prices relative to their long-term earnings,
Yeah.
is near all-time highs, second only to 1999.
And remember what happened after 1999, a decade of essentially flat stock market returns?
Yeah,
It's a little unnerving.
it is. And to add to that, even Warren Buffett,
Oh, wow.
one of the most successful investors of all time, is sitting on a massive cash pile right now.
Wow. If Buffett is being cautious, maybe we should be too.
Maybe so.
So what's he waiting for? Is he just biding his time, or are there specific signals he's looking for before jumping back into the market?
That's a great question, and I think it's one that a lot of investors are asking themselves right now.
All right, so we've got pricey stocks. Even Buffett is playing it safe.
Right.
What about bonds? Are they looking any more attractive in this environment?
Let's dive into the bond market next.
So let's talk bonds. They're usually seen as this safe haven when stocks are volatile.
Yeah.
Is that still true in this current environment?
Well, it's a bit more complicated than that.
Okay.
You see, when we talk about bonds, we have to consider different types and maturities. For example, are we talking about short-term bonds that mature in a couple of years or long-term bonds that mature in 10, 20, or even 30 years?
Right, so different flavors of bonds, and they probably react differently to all this economic uncertainty.
Precisely. And another key factor is the issuer of the bond.
Okay.
Are we talking about U.S. Treasury bonds, which are backed by the full faith and credit of the U.S. government?
Right.
Or are we talking about corporate bonds,
Yeah.
which are issued by companies?
Right, so U.S. Treasuries are generally considered less risky than corporate bonds.
Exactly.
Yeah.
And that difference in risk is reflected in what we call the yield spread.
Okay.
The yield spread is basically the difference in interest rates between two types of bonds.
So if a U.S. Treasury bond is paying 4% interest and a corporate bond from, say, a tech company is paying 6%, then the yield spread is 2%.
You got it.
Okay.
And when times are good and investors are feeling confident,
Yeah.
that yield spread tends to narrow
Uh-huh.
because they're willing to take on more risk for a little extra return.
Makes sense.
But when uncertainty creeps in, like we're seeing now,
Yeah.
that yield spread tends to widen
Okay.
as investors flock to the safety of U.S. Treasuries.
So what's happening with yield spreads right now? Are they widening or narrowing?
It's interesting, Dyer notes that corporate bond spreads are actually quite tight to Treasuries at the moment,
Really?
which historically can be a cause for concern.
So even with all this economic uncertainty, investors aren't demanding much extra yield for holding corporate bonds.
Right.
That seems a little counterintuitive.
It does, and it's something that professional investors are watching very closely.
Okay.
Dyer frames the question this way: do you want to be short yield?
Okay.
In other words, is buying a corporate bond really going to make you more money than just holding a treasury given the tight spreads?
So it's not just about whether corporate bonds are a good investment in isolation.
Right.
It's about whether they're a better investment than other options out there.
Exactly.
Okay.
And when spreads are this tight, it takes a much bigger move in the market for a corporate bond to outperform a treasury.
So less room for error,
Yeah.
less wiggle room if things take a turn for the worse.
That's a good way to put it.
Okay.
And this is especially true on the longer end of the maturity spectrum.
Okay.
Dyer points out that a small spread widening on a long-dated bond can wipe out your entire income advantage.
Wow.
It's all about duration risk, which is the sensitivity of a bond's price to changes in interest rates.
Okay.
The longer the maturity, the greater the duration risk.
So long-duration corporate bonds are looking a little dicey right now.
Potentially, yeah.
What about for everyday investors who aren't necessarily making these complex calculations?
Right.
What's the takeaway for them?
Dyer's advice is to be cautious and consider your individual risk tolerance.
Okay.
Perhaps avoid those very long-duration corporate bond funds for now.
So tread carefully in the corporate bond market.
Yeah.
But Dyer seems to be generally optimistic about the overall economy, right? No signs of imminent collapse or anything like that.
No, he doesn't see the same red flags that have preceded past recessions.
Okay.
Like massive credit bubbles, unsustainable spending sprees, or widespread accounting scandals.
Right.
But he does emphasize that things can change quickly.
Mm-hmm.
And he thinks there's one thing investors should be watching most closely.
Okay, I'm all ears. What's the canary in the coal mine?
Dyer suggests that the real danger zone might be if the government's borrowing plans become unacceptable to investors.
Right.
Remember that Liz Truss moment we talked about?
Oh, yeah.
When investors lose confidence,
Yeah.
things can unravel quickly.
Those bond vigilantes can really shake things up.
It can.
So we need to keep an eye on how the market is reacting to the incoming administration's fiscal policies.
Exactly.
Any other indicators we should be paying attention to?
Absolutely. Dyer highlights a few key things.
Okay.
First, watch the overall level of interest rates.
Okay.
If they rise too high, it could stifle economic growth and potentially trigger a recession.
Right. The Fed has to walk that fine line between controlling inflation and keeping the economy humming.
Exactly. And another thing to watch is inflation itself.
Okay.
If it starts to buzz up, the Fed might be forced to raise rates more aggressively.
Yeah.
Which could spook the markets.
So a lot of moving parts and a lot of potential for things to go awry.
There is.
But is there anything we can do to prepare ourselves for these potential risks?
Sure.
Besides hiding under the covers, that is...
The key is to stay informed and adaptable.
Okay.
Don't panic, but don't be complacent either.
Right.
Pay attention to the economic data, be aware of the political landscape, and be prepared to adjust your investment strategy as needed.
Solid advice, knowledge is power, as they say.
It is.
And the more we understand about the forces shaping the economy, the better equipped we'll be to make smart decisions.
I completely agree. And don't be afraid to ask questions, seek out different perspectives, and keep learning. There's a wealth of economic information out there.
Right.
And it's more accessible than ever before.
So keep those brains engaged, the eyes peeled, and those wallets ready for whatever comes next. We've given you the tools. Now it's up to you to use them wisely.
Well said. And I'll add one more thing that Dyer mentioned. Pay attention to the stock market, but don't let it be your only guide.
Yeah.
The economy and the stock market are not always in sync.
True. The stock market can sometimes be a bit of a wild ride driven by emotions and short-term thinking.
Right.
We need to look at the bigger picture.
And speaking of the bigger picture, remember that even the experts are grappling with uncertainty right now.
Yeah.
Dyer mentioned that Warren Buffett is sitting on a mountain of cash waiting for the right opportunity.
Well, that's actually quite reassuring in a way. If even the Oracle of Omaha doesn't have all the answers,
Right.
it makes the rest of us feel a little less clueless.
Right.
So as we wrap up this deep dive, what's the main message you want to leave our listener with today? Yeah, it does seem like we're in a bit of a wait-and-see mode right now.
Yeah.
See how things shake out with this new administration and the Fed and just the whole global economic picture.
Yes, I think that's a fair assessment. A lot of potential scenarios.
Yeah.
It's hard to predict with certainty which one will unfold.
So no crystal ball predictions, but what can our listener do to stay ahead of the curve and protect their financial well-being? What's the one piece of wisdom you would impart to them?
I think the most important thing is to focus on what you can control.
Okay.
You can control your savings rate, your investment strategy, your overall financial plan.
So it's about taking those proactive steps instead of just,
Yes.
reacting to whatever the market throws at us.
Exactly, and that starts with educating yourself.
Yeah.
Understand the basics of investing, stay informed about economic trends, and don't be afraid to ask questions.
There's so many resources available these days.
There are.
Podcasts like ours, financial websites, books, articles.
Yeah, it's all at our fingertips.
It really is. And remember, you don't have to be a financial expert to make smart decisions.
Right.
Just start with the fundamentals,
Exactly.
build a solid foundation, and don't be afraid to seek professional guidance when you need it.
I think that's a great point.
Yeah.
Sometimes we get overwhelmed by all the noise and think we need to have all the answers ourselves.
Yeah, you think you got to do it all.
But there are people who can help us navigate these complex waters.
For sure. Absolutely. And don't underestimate the power of patience.
Yes,
Investing is a long game.
absolutely.
There will be ups and downs.
Sure.
But if you stay focused on your goals and you stick to your plan,
Yeah.
you'll be well positioned to kind of weather any storm that comes your way.
And maybe even come out stronger on the other side.
Right. It's like that saying,
Yeah.
the best time to plant a tree was 20 years ago. The second best time is today.
I love that analogy. It's so true. It's never too late to start investing in your future.
Well, on that note of optimism and empowerment,
Yes.
I think we've covered a lot of ground
We
today.
have.
We've talked about, the potential worries and challenges facing the economy, but we've also highlighted, the opportunities and the importance of taking control of our financial destiny.
It's been a pleasure diving into these topics with you
Yeah.
and our listeners today.
Absolutely. Thanks for joining us for this deep dive.
Yeah, thanks for listening, everybody.
Remember, knowledge is power, and the more informed we are, the better equipped we'll be to navigate this ever-changing economic landscape.
Absolutely.
So until next time, stay curious and keep learning.